Imagine waking up, checking your investment account, and seeing a balance of $1 million. Now imagine the best part. Every single penny of that $1 million is completely tax-free. If you withdraw $10,000 for a vacation, the government gets nothing. If you withdraw the whole million, the government still gets absolutely nothing. This isn't a pipe dream, or some sketchy offshore tax loophole. It is a completely legal, government-approved strategy using an account that millions of Canadians already have but massively underutilize. We are talking about the tax-free savings account, or TFSA. Most people use their TFSA as a basic savings account, letting their money sit there earning a microscopic amount of interest, while inflation slowly eats away at its purchasing power. That is a massive mistake. The TFSA is actually the most powerful wealth-building tool available to everyday Canadians, and today, you are going to learn exactly how to turn just $500 a month into a cool $1 million right inside it. To understand how this works, we first need to clear up the biggest misconception in Canadian finance. The name tax-free savings account is incredibly misleading. It really should have been called a tax-free investment account. When you leave your money in cash inside a TFSA, you are essentially using a Ferrari to drive down a school zone at 20 kilometers an hour. The real magic happens when you use that account to buy assets that grow over time, like stocks, exchange-traded funds, and index funds. The superpower of the TFSA is that any capital gains, dividends, or interest you earn inside the account are shielded from the Canada Revenue Agency forever. So how do we get to that $1 million mark by contributing $500 a month? It all comes down to a mathematical phenomenon that Albert Einstein famously called the eighth wonder of the world: compound interest. Compounding is what happens when the money your money makes starts making money of its own. In the beginning, the progress feels agonizingly slow. If you invest $500 a month at an average annual return of 9%, after year 1, you will have about $6,300. It doesn't look like much, and it certainly doesn't feel like you are on the path to becoming a millionaire. By year 5, you have around $38,000. Still a long way from 7 figures, but as the years roll on, the math starts to accelerate. By year 15, that snowball has grown to nearly $200,000. By year 25, you are sitting on overfly past $550,000. And by year 33, the magic happens. Your total contribution over those years was just under $200,000, but your total account balance crosses the $1 million finish line. More than 80% of your wealth at that point didn't come from your own pocket. It came from market growth and compounding working for you, in the background while you slept, achieving a 9% average annual return. Might sound intimidating if you try to pick individual stocks, but the beauty of this strategy is that you don't need to be a Wall Street genius, or spend hours analyzing financial statements. You can achieve this by investing in broad market index funds, or ETFs that track the entire stock market, such as the S&P 500 or an all-equity asset allocation ETF. These funds essentially let you own a small piece of hundreds of the most successful companies in the world all at once. Historically, the broader stock market has delivered average annual returns between 8 and 10% over long periods. While the market will definitely have down years where your balance drops, the historical trend over decades has always moved upwards. The secret isn't timing the market, it is time in the market. Of course, to make this strategy work, you have to play by the CR's rules, and the most important rule is your contribution room. You cannot just dump unlimited amounts of money into a TFSA. Every year, the Canadian government sets a new limit on how much you can contribute. For instance, the limit has floated around $6,000 to $7,000 annually in recent years. If you are consistently contributing $500 a month, that totals $6,000 a year, which fits beautifully within the annual limits. Better yet, if you have been eligible for a TFSA since it was introduced back in 2009 but haven't fully utilized it, you likely have tens of thousands of dollars in unused contribution room backed up, giving you plenty of space to supercharge your investing journey right now. Just be absolutely certain you do not over-contribute, as the CR penalizes over-contributions at a harsh rate of 1% per month on the excess amount. Another critical trap to avoid on your journey to $1 million is day trading inside your TFSA. Because the tax-free benefits are so massive, Some people try to use the account to frequently buy and sell volatile stocks or crypto within days or hours to make a quick buck. The CRA monitors this closely. If they determine that you are using your TFSA to run a day trading business, they can strip away your tax-free status and tax all of your gains as business income. To build lasting wealth, you want to adopt a passive, long-term buy and hold strategy. You automated your $500 monthly contribution, you buy your diversified funds, and you leave them alone to do their job. Consistency is the ultimate differentiator between those who dream of financial freedom and those who actually achieve it. Life will absolutely throw distractions your way. There will be months where your car needs repairs, or you want to go on an expensive holiday, or the headlines on the news are screaming that the stock market is crashing. The investors who reach the $1 million milestone are the ones who treat their $500 monthly investment as a non-negotiable expense. Just like rent or groceries, they don't stop investing when the market dips. In fact, they look at market dips as a clearance sale, buying up more shares of great companies at a discount. Turning $500 a month into $1 million inside your TFSA is not a matter of luck, and it doesn't require a high-flying corporate salary. It requires patience, an understanding of the right financial tools, and a commitment to letting time do the heavy lifting. The best time to start was years ago, but the second best time is right now. Every month you delay is a month of compounding power you can never get back. Thank you for spending some time with me today to invest in your financial future. If you found this breakdown valuable, make sure to hit that like button and subscribe so you never miss an update on how to make the Canadian financial system work for you. Let me know in the comments below if you are currently utilizing your TFSA for investing or if you are planning to start this month. For more straightforward, practical strategies on mastering your money, building generational wealth, and navigating retirement here in Canada, keep it locked right here to Canadian Finance Hub with James.